it's almost like the banks are saying, hey, use this, like let's guarantee and lock in this rate, this interest that we're going to receive as a bank, because they have a really good understanding of the market, and they also think rates are going to come down over time. And so at some point, even though today maybe the fixed rate is a little bit better than the variable, in the next year the variable likely is cheaper than the fixed rate, and the bank will end up winning because they'll collect more interest. So there's a little bit of an incentive right now to choose the fixed versus the variable. A couple other things on the HELOC. There's a draw period. So the way that these loans work, they are typically 30-year loan terms. That's the repayment. That's how long you have to repay that debt. But within a window of time they call a draw period, you're going to have the ability to throw chunks at that loan if you wanted to pay it down and open up the line of credit, and then to borrow money back off of it. And you can do that as often as you'd like in that draw window. Now, a lot of these loans are either a 3-year, a 5-year, or a 10-year draw window, where they allow you to do that off and on as you choose for those periods of time. Now, the loans that price the best usually have a shorter draw window. So if you don't plan to use this all the time, you're just going to use it maybe for the next couple of years, a 3-year draw window is just fine. You'll probably get better terms on seeking something like that. But if it's something you want to just set up and be done with, and you intend to use it on an ongoing basis, maybe you need a 5 or a 10-year draw window. You just might have a little bit of a premium on what that loan looks like on the total terms of that loan. Now, the payments that are on these loans are done interest only for the first 10 years on almost all of them. There are some variability between different banks, but most of the time for the first 10 years, you're going to pay back just the interest on the loan as your minimum monthly payment. And you can pay as much as you want. You can throw whatever you want to for principal and get that loan paid down very quickly, just so you're not paying interest on that extra money that you maybe don't need. Maybe you have extra cash in the bank and you look at it and you say, hey, these are up in the 7s and 8% range. Maybe it's a good idea for me to dump some of this money there versus letting it sit in my savings account and I'm not making any interest on it. So a good place to park that money and then still have access to it in an emergency or in the future as you so need.